Investing. What's that factor?
Hi, John from Modulus Financial Planning here, and I'm going to be talking briefly today about the size factor in relation to investing. The question is, does size really matter? And yes, apparently it does. Basically, size factor means that smaller companies or small cap stocks show signs of a returns premium over larger companies or large cap stocks. In layman's terms, this means there's academic evidence proving that smaller companies have the potential to outperform large companies over the long term. Small and large cap companies are classified due to their market capitalization. That is their overall valuation, which is the number of shares multiplied by the share price. It's fairly straightforward. The overall valuation of a smaller company is generally between $300 million up to $2 billion. Examples of these companies include Crocs, Domino's Pizza in the UK, Aston Martin and GoPro. Not exactly small, are they? And how many of these companies have the potential to become large cap companies over time? You'll also notice some local companies in the UK and Ireland such as Kainos, First Derivatives and Bank of Ireland. Small cap companies are often young or younger companies. They are already established and are trading in the stock market. Usually they tend to have good growth potential but may be less stable than their larger, more established peers. As such, smaller companies are inherently riskier than large cap companies. They will generally have more debt, less liquidity, that means they're harder to sell, have lower profitability and higher volatility. That means their share price goes up and down more. This means there needs to be some additional payback to an investor for the extra risk they take holding these companies. That payback shows itself as the size premium, meaning you can expect higher returns over time for the risk taken. Due to the inherent risk in a size factor, we don't advise our clients simply to hold small cap funds. As the evidence shows that smaller companies can potentially provide better returns than larger companies, we take a view that we tilt slightly to smaller companies in our portfolios. That doesn't mean we ignore the great companies of the world such as Apple, Procter & Gamble, Nike, Berkshire Hathaway to mention a few. We hold all these companies as part of our portfolio, but we also hold some smaller companies so that we can access the size premium in a controlled manner. The key to successful investor experience is managing behaviour and expectations. That means ensuring you stick to the plan, trust the process and don't panic when things don't look good. A well-diversified portfolio which follows an asset allocation model and is aligned to your risk profile will help drive your financial plan over time. So that is a brief bit about the size factor in relation to investing. As always, if you have any questions or queries in relation to this, then please feel free to email us using the contact details at the end of this video or via our social media channels. Thank you.